Most people think investing is complicated, something you need a finance degree, a big salary, or a lot of time to figure out. But really, that's not true. Investing is simply a way of putting your money to work, so it grows while you're living your life. In this video, I'll walk you through exactly how investing works and show you how to make your first investment today, even if you only have 10 minutes and $1 to start. So let's start with the basics. Investing is about giving your money to businesses that need cash to grow. And in return, those businesses share a portion of their success with you. Let's say your cousin Pete is a software developer who wants to leave his job and start his own company with his friends. They call the business North Peak Software, and they plan to build custom apps for local businesses. But before they can get started, they need funding. So they decide to divide the company into 100,000 shares priced at $10 each, which means the business is valued at $1 million. The three founders put in some of their own savings and they end up owning 60% of the company. To raise the remaining $400,000, they reach out to family and friends to see who's willing to invest. Now, you know Pete's talented and serious about his work, so you decide to invest, say, $5,000. In exchange, you receive 500 shares, or 0.5% of the company. They then use the funds to pay for their salaries, rent a small office, and buy equipment. Within a few months, they land several clients, and by the end of the year, they're profitable enough to pay investors a small dividend of, say, $2 a share. This is basically a small bonus that companies can offer investors to thank them for their ongoing support. Now, since you own 500 shares, you receive $1,000 in dividends that year, and your original $5,000 investment is still yours. You decide to keep your shares, and over the next 10 years, the company grows steadily. It hires more developers, expands internationally, and it becomes a respected name in the industry. The share price rises from, say, $10 to $60, so your 500 shares are now worth $30,000. And if you do the math, you basically profited $25,000, in addition to the dividend payments, all without lifting a finger. And yeah, that's pretty much it. That's the beauty of investing. You took a calculated risk on a business you believed in and were rewarded as it succeeded. Now, the same idea applies to every publicly traded company. So for instance, Jeff Bezos started Amazon in his garage in 1994. Early investors who put in $10,000 would now have more than $14 million. And when companies like Amazon or Apple go public, anyone from the mailman to the grocery store clerk can buy a share of their growth through the stock market. Years ago, this all happened on a loud, crowded trading floor on Wall Street, where brokers shouted orders and waved papers in the air. Today, the entire process happens online, and anyone can buy or sell shares right from their phones. Once a company is listed, it regularly publishes financial reports so investors can evaluate its health. If the business grows, its share price tends to rise, and investors can earn dividends or sell their shares for a profit. For example, Apple shares traded around 10 cents in the early 1980s. Today, they're around $220 per share. That's an increase of over 200,000% for long-term investors. And even if you don't have hundreds or thousands of dollars, you can still invest. Most platforms now can let you buy these things called fractional shares. So you can start with as little as literally $1. There are many other types of investments like bonds, exchange-traded funds or ETFs, mutual funds, and real estate. But they all follow the same basic principle. You put your money into something that has the potential to grow, and if it performs well, you share in that growth. For the rest of the video, we'll focus on the stock market because it's the easiest and most accessible way to make your first investment. Now hold on, before I tell you how to make your first investment, I need to be honest with you about two exclusion criteria. The first is what I've said many times before is high interest debt, and this includes credit card or personal loans. This kind of debt grows faster than most investments, so paying it off first is the smartest move you can actually make. The second thing you need is an emergency fund with at least 3 to 6 months of living expenses in a high-yield savings account. Trust me, this is what's going to keep you covered when life happens and stops you from cashing out your investments too soon. If you don't have these in place yet, then it's okay. Take care of those first. Then you can come back to this video and start investing the right way. Alright, the best place to start, in my opinion, is to invest in exchange-traded funds, or ETFs. This is basically a basket of shares of many different companies. When you buy one share of an ETF, you're essentially investing in hundreds of companies all at once, which basically helps you spread your risk. Now let's go back to your cousin's company, North Peak Software, which is now listed on the stock exchange under the ticker symbol NPS. You could buy more shares of NPS directly, but if something goes wrong at their company, you'd feel the full loss. However, with an ETF, the risk is reduced because your money is spread across multiple businesses. For example, a large financial institution like Vanguard or BlackRock might create a technology-focused ETF, something like the Vanguard Information Technology ETF or VGT. It includes companies such as Apple, Microsoft, Nvidia, and other tech firms. So if one company struggles, the others can still balance it out. If you just buy one share of VGT, you instantly own a fraction of every company inside that fund. And as those businesses grow and grow their profits, the value of your ETF also increases. If the sector slows down, your investments may dip, but because it's diversified, the swings are usually much smaller than investing in a single company. That's why, in my opinion, ETFs are ideal for beginners. They basically give you access to the stock market without needing to research and pick individual stocks. So with that in mind, let's take a look at the steps you need to start investing now, which honestly won't take you more than 10 minutes. First, you need to choose a brokerage. This is basically a platform where you'll buy and manage your investments. And you can also think of this as the modern Wall Street in your palm. Now, there are plenty of options in the US, but personally, I use Fidelity and Schwab. Both offer easy to use mobile apps so you can manage your portfolio anytime. And both have zero commission trading for ETFs and most stocks. If you want to explore more, check out Investopedia's latest brokerage rankings. Fidelity and Schwab consistently rank among the top for beginners and ETFs. Now, once you've signed up with a brokerage, you'll need to open an account to actually start investing. You'll see options like a traditional IRA, Roth IRA, or rollover IRA. If you're just starting out and if you qualify, a Roth IRA is often the best choice. This is because you pay taxes on the money before it goes in, which means that your investments grow completely tax-free later on. So when you retire at 59 and a half, you can withdraw your money without paying any taxes on the gains. You can also withdraw any of your initial contributions anytime without any penalties, giving you more flexibility than most retirement accounts. Honestly, it's a pretty simple, tax-efficient way to build long-term wealth. And really, it's a great foundation for any beginner investor living in the US. Now that your Roth IRA is open, it's time to fund it. There are no required minimums, so you can start with as little as, say, $10 or $20 or even, say, $1. However, the maximum annual contribution limit for 2025 is $7,000 if you're under 50 or $8,000 if you're over 50. That's roughly $583 per month if you're under 50 or $666 per month if you're over 50. For 2026, it's a little bit different. The maximum annual contribution limit is $7,500 or $8,500 if you're over 50. For most people, you want to try to contribute as much as you can, but what matters the most is that you do it consistently. You can set up an automatic transfer from your bank account so you're investing a set amount every month. That way, you don't have to rely on willpower or timing the market. For me personally, I automate all of my deposits. It keeps me disciplined and removes any temptation to skip a month. Your Roth IRA is now ready, but you still need to decide what to invest in. A Roth IRA is just the account, the vehicle, and it's up to you to choose the investments that go into it. For most beginners, ETFs are a smart and simple choice because they spread your money across hundreds of companies, so your risk is diversified. So here are a couple of examples. Again, you can invest in whatever you're comfortable with. First are S&P 500 ETFs, and this includes, say, SPY, VOO, or SPLG. And basically with these ETFs, they track the top 500 companies in the United States. Next, you can invest in something that tracks the NASDAQ 100, like QQQM or QQQ, and this helps you focus on tech-heavy companies. Next, you can also invest in dividend-paying ETFs, and this can include something like SCHD, VOIM, or SPYD, and this is going to be great for you if you want income payouts every quarter. So really, for your first investment, you don't really want to overthink it. Maybe just start by picking an ETF that tracks the S&P 500. And yeah, you can buy your first share or even a fractional share. And once that's done, then congratulations, you've officially made your first investment. So what's next? Well, I use something that I call the 1-1-1 method, which is a simple, long-term investing approach that anyone who has $500 can follow. So here's how it basically works. You buy one share of an S&P 500 ETF valued at around $500 one time per month, and you keep doing that for 30 years until you reach $1 million. So that's 1-1-1. But even if you don't have $500 right now, you can start with any other amount. If today you start by putting $1 a month, and then next month it's $5 and then $10 a month, and then you slowly build up to the maximum amount for your Roth IRA of say $583 per month, and you start investing in your 20s, then you should hit around $1 million in around 30 years. So you can use the 1-1-1 method even if you can't make the full $500 payment immediately. The sooner you start this habit, the sooner you'll reach your goals. Now remember, investing is a long-term game. The market will rise rise and fall, and that's perfectly normal. If your ETF dips one month, don't panic or stop investing. Instead, I challenge you to zoom out and look at the bigger picture, like literally. If you look at any graph of a well-known ETF, you'll see that over time, broad market ETFs like the S&P 500 have always recovered and continue to climb. Now that you know how to invest, I truly hope you'll make your first investment today and join the ranks of people taking control of their finances. But keep in mind, this was just a quick overview. If you want to go deeper and learn how to build a complete investment plan, join my beginner's investing masterclass here.